Examine the chart presented, which delineates the beneficiaries and detractors of globalization from 1988 to 2008, as evidenced by income growth. A significant portion of this data highlights China, where millions have transitioned from poverty into the middle class. In stark contrast, the lower middle class in the United States and other Western nations has faced stagnation in income levels. Meanwhile, the top 1% have seen their earnings surge, mirroring the advancements of China's burgeoning middle class. This raises a critical inquiry: who genuinely reaps the rewards of globalization? This chart provides essential context for understanding the political dynamics that contributed to Trump's election and his subsequent implementation of tariffs. While China's narrative promotes a perception of universal benefit derived from its manufacturing capabilities, a closer examination reveals this to be largely propagandistic. To challenge this narrative effectively, your engagement through liking and subscribing can enhance our video's visibility on YouTube. The history of global trade traces back to 1947, following World War II, when United Nations members convened in Switzerland to sign the General Agreement on Tariffs and Trade, GATT. This agreement, endorsed by 23 nations, significantly lowered international trade tariffs with strong leadership from the United States. At that time, Europe and Asia were recovering from war devastation while much of the global south remained unindustrialized. Thus, the US commanded over half of global GDP, a remarkable monopoly. With unparalleled naval power at its disposal, the US ensured secure trade routes while enhancing its global standing through fostering international commerce with Europe and Asia. Beyond geopolitical considerations, free trade was championed as a catalyst for economic growth based on comparative advantage theory. The premise is straightforward: if each nation specializes in producing what it does best, overall global production increases. This principle laid the foundation for gradually dismantling trade barriers. The chart illustrates a significant decline in US import tariffs, from 57% in the 1800s to 7.9% by 1947 and further down to 2.5% by 1995. The year 1995 marked a turning point with the establishment of the World Trade Organization, WTO, in Geneva, aimed at globally reducing tariffs and other trade barriers. The WTO now comprises 166 members representing approximately 98% of global GDP and about 93% of world population. Since its inception, US import tariffs have continued their downward trajectory, falling below 1.5% during the 2010s, facilitating deeper globalization characterized by an astonishing increase in global trade volume by 4,400% from 1950 to 2023 and an escalation in worldwide GDP from $12 trillion in 1950 to $167 trillion by 2021. However, these figures only provide a partial view, necessitating further scrutiny. To comprehend today's landscape of US international commerce requires an analysis of trade balance, the differential between what is exported versus imported by the US. Exporting involves selling goods abroad, while importing entails purchasing them from foreign markets. A longitudinal examination reveals a troubling trend: consistently higher imports than exports, leading to an expanding trade deficit which reached $1.22 trillion solely in goods by 2024. A situation that began escalating during the late 70s and 80s, primarily due to Japan's thriving automotive and electronics sectors positioning itself as a formidable economic competitor. This scenario incited domestic concerns voiced prominently by figures such as Donald Trump during a televised appearance in 1998 where he criticized Japan's market practices, accusing it of flooding US markets while erecting barriers against American products, thus challenging free trade principles altogether. As we advance towards future projections for China's role post-2025 emerges prominently amid shifting dynamics. Reforms coupled with competitive labor costs propelled China's manufacturing sector throughout the 90s, resulting in unprecedented export growth directed towards America. By around 2028, China had ascended as principal contributor to America's trade deficit, amounting to $419 billion, or roughly 2% of US GDP. A situation exacerbated further through contributions from Mexico, Vietnam, Germany among others, all adding billions into this deficit equation, where many goods exported are routed via these countries, originating ultimately from China, thereby inflating actual deficits beyond official statistics. Discussions surrounding this persistent trade deficit often pivot towards implications for American employment. As manufacturing relocates overseas, local wages experience upward pressure whilst stagnation persists within American middle-class earnings, underscoring lackluster reciprocity inherent within current trading practices, particularly concerning China's engagement post-2001 accession into WTO, wherein commitments made regarding market access remain largely unfulfilled over nearly 25 years, despite pledges made at that time. During subsequent decades, tariff impositions ranging between 3 to 5% were levied upon imports entering Chinese markets, juxtaposed against mere 1.5% duties imposed upon incoming goods into America, creating an uneven competitive landscape favoring Chinese enterprises over their American counterparts, facing substantial entry barriers reminiscent historically akin Japan's past practices, violating established WTO guidelines yet continuing unabatedly today, forcing strategic partnerships often necessitating joint ventures wherein Chinese firms acquire majority stakes, mandating local production alongside access demands pertaining intellectual property rights held by American partners. Moreover, intellectual property theft perpetrated through cyber means exacerbates these challenges, costing U.S. economy approximately $600 billion annually. Cumulative losses far surpassing those attributed directly, attributable deficits stemming instead primarily resultant IP misappropriation, facilitating accelerated innovation within Chinese firms, contravening established norms set forth under WTO framework, whilst failing transition away state-controlled economic models remains elusive, according United States Trade Representative, identifying China foremost challenge confronting contemporary trading systems despite extensive tenure within WTO confines, maintaining non-market-driven approaches contrary foundational principles espoused therein. State-owned enterprises constitute 40% share within China's GDP, whilst every ostensibly private entity reflects CCP influence permeating upper echelons, raising concerns regarding potential exploitation arising. Open access afforded American markets, enabling tax policies, subsidized loans, political leverage exerted steel producers, culminating substantial overproduction scenarios, disadvantaging Western counterparts across various sectors including solar panels, electric vehicles, currently extending into AI, semiconductor domains, alike compounding effects, resultant IP theft barriers, foreign businesses, preferential treatment, domestic industries, widening existing U.S. trade deficits, impacting lower middle-income Americans disproportionately, requiring deeper consideration, examining economic trends spanning periods between 1988-2008, revealing stark contrasts wherein Asian middle classes alongside top 1% experienced income surges exceeding 80%, whilst stagnation persisted amongst lower middle-income groups across Western nations, inclusive America, contributing partially underlying disparities observed today linked directly outsourcing manufacturing operations abroad, benefiting primarily elite professionals, yielding sizable bonuses, multinational firm executives gaining competitive advantages leveraging cost-effective production methodologies overseas, leaving behind neglected lower middle-class demographics stateside amidst complexities inherent free trade frameworks warranting thorough investigation given implications arising. Persistent imbalance reflected GDP statistics alone do not encapsulate realities faced everyday citizens grappling stagnant wage growth despite record low unemployment rates. Prevailing current climate analysis indicates bottom 90% earners experiencing minimal real income gains, less than 0.5% annually, adjusted inflationary pressures, dire circumstances afflicting bottom 50, conversely top 1% enjoying nearly tenfold real wage increases, exacerbated conditions tied closely increasing deficits driven outsourcing benefiting select few executives, investors profiting substantially, arrangements undermining long-term sustainability, engaging foreign entities, presents uncertain ramifications, particularly given efforts undermine domestic enterprises, potentially threatening even wealthiest segments society. Presently capital flows directed either low-skilled foreign employment, high-skilled domestic roles, leaving behind vulnerable populations overlooked amidst broader narratives surrounding economic prosperity depicted superficially via aggregate metrics, failing capture nuanced realities affecting lives, individuals residing beneath surface-level statistics, contributing sentiments resonating electoral success witnessed Trump's campaign, notably Rust Belt states Michigan, Pennsylvania, Ohio, Indiana, Wisconsin, promising address inequities stemming unfair practices, revive lost jobs, resonating deeply constituents seeking tangible solutions addressing pressing issues confronting communities nationwide. Currently, Trump employs tariff strategies fulfilling campaign promises aiming bolster competitiveness, protect domestic industries, generate revenue, potentially facilitating tax reductions, approach termed protectionism historically yielding mixed outcomes benefiting developing nations, early United States, Germany 19th century, more recently Japan, South Korea, China. Conversely, detrimental impacts observed Brazil, India, Argentina, instances mismanagement leading adverse consequences, long-term growth trajectories, protectionist measures risk engendering complacency among domestic industries industries lacking incentives innovate compete effectively, isolating economies, curtailing opportunities export goods, thereby hindering overall progress. The prevailing situation warrants serious concern should current policies persist. Likelihood remains lower. Middle-income demographic continues face mounting challenges navigating complexities associated. Free trade paradigms necessitating thorough examination. Underlying mechanics driving persistent deficits. Purchasing patterns whereby America acquires greater volumes than sold, resulting accumulation. Excess dollars held. Foreign entities reinvested back into U.S. economy, encompassing treasuries, corporate debts, equities, substantial farmland, real estate acquisitions. Economists characterize dollar circulation phenomenon balance payments suggesting attractiveness, investment hub aiding consumer price reductions. However, unchecked influx foreign investments poses potential threats. Currently foreigners, including Chinese investors, hold 24% U.S. government debt, 30% corporate obligations, own 20% stock market. Nearly 10 residential properties acquired recent years, reflecting significant trends indicating vulnerability. Emerging geopolitical rivalries. Ownership stakes represent notable risks should acquisition patterns persist, could culminate governmental corporate indebtedness granting adversarial powers considerable control territory. In light ongoing disputes surrounding U.S.-China relations, subscribing channel will provide timely updates, insights, developments shaping discourse surrounding critical issues impacting future trajectories. Both nations navigating complex interplay. Economics, geopolitics, evolving landscape warrants vigilance, engagement, informed perspectives necessary, comprehending multifaceted dimensions underpinning contemporary challenges faced globally.